we'll basically look at financials. It's kind of a pet topic of mine because being financially trained is a bit of a boon and a curse. You tend to look at numbers a bit too frequently and too closely. But now that we are in the final stages of getting the pitch deck ready, it's a good time to kind of talk about financial statements, and especially with the perspective of what is important for startups, and also what actually goes into the pitch deck. It's important to understand a few things. Firstly, the basics of how financial statements actually work. And the reason why it's important to understand the basics is that, you don't need to be a chartered accountant. Not every founder is a chartered accountant, right? But you need to understand how they work, the basic mechanics. And then you need to understand what do investors look for, right? So you need to be able to speak that language. And that's the reason why this becomes important. So what we are going to talk about today, today's talk is going to be slightly heavy, but I've tried to make it as practical and as experiential as possible, right? While still providing the necessary insights and some tools as well to help all the teams, come up with their slides for the pitch deck, right? So we'll look at a few things today. We'll look at firstly financial statements, more classically, the purpose and the key mechanics of the financial statements. And like I said earlier, not every founder is a chartered accountant or needs to be a chartered accountant. If you guys scale your companies, grow your companies well, you'll probably hire chartered accountants, and there are many of them available, right? There are not too many founders. So, but to be able to, but you still need to be able to read, understand financial statements, how they're made, how projections are actually developed, and why it's important. So we'll talk a little bit about that in the first part, of financial statements. The second part of today's session is, the specifics of the actual slides that you need to make, because your pitch deck, the last couple of slides will typically be focused on financials. So how are these actually typically prepared? What do investors look for? What are the pitfalls? What mistakes people make? And so a lot of stuff that, I've learned from my experience, over the last 20 plus years, I have looked at hundreds of financial statements, as like even before I became a founder, I was actually an investor, managed a fair bit of money. Have looked at hundreds of, statements, and distilled from that, some experience, that I want to share with the group, and then, which is useful, and hopefully that will become a good input into your pitch deck slides, the financial portion, right? The third part of today's session is on metrics that matter to investors. And here, actually, I'm going to talk about actually only one business model. So I'm going to leverage a presentation that, a very good presentation that is on the Y Combinator YouTube channel. And I'll talk through one examples that's shown, in that presentation. And all teams can take a look at the presentation later. I'll include details, right? But it's a really good resource, for the kind of metrics that investors look at, especially for early stage companies, and especially at the time of fundraising, right? What I've also included in this session, we'll very quickly cover are some resources. So, a couple of templates I found quite useful, templates for your financial slide. Yeah, you can directly use. In fact, that's the example that I'm going to talk about in, the second part of today's session. Also included in the appendix is, one particular website that I like. I've used it in the past. They have some good financial models, that you can download. And we'll look at that as well very quickly at the end. Yeah. So let's get started. So the first part is the financial statements. So here, the most important thing to understand for this group, right, is it's always good to start with why. Yeah. So why financial statements? For a startup at the early stage, which might have, let's say, very little operating history. So there might be a year, 2 years, maybe less than that of historical performance, and a lot of your story that you present to investors and other stakeholders will be about your future. So that it will be about projections. So financial statements really, looking back as well as looking forward, right? Let me quickly kind of go around the group, and since we have all founders on the call, let me quickly do a check on two things. First one is how many, and you can actually maybe in the chat channel you can mention or even raise your hands, right? How many of the founders are actually financially trained? So they've attended some kind of course, or either in B school, or they might have taken some accounting or other financial literacy program. How many of these? How many of the founders do we have who have some training? Okay, so I see 4 responses. So that's actually not bad at all, right? And about half of the group, nearly half, has had some training either through a course in the MBA or some kind of practical experience. The others, don't obviously have any experience, and that's why I think this session will be quite insightful for those who've actually not had any training as well. Again, this session is not really about giving you a training program on accounting or finance, but looking at it more from a investor point of view, right? So what do you need to look out for as a founder when you're trying to raise funds? So what's the purpose of the financial statements, right? So look at it this way. There are 2 parts of it: backward looking and forward looking, right? So what you have done in the past, so it's like a rear view mirror. So you're able to see, your historically what your performance has been. In the case of most of you, and startups, there's not much of past performance. So the main thing that is important is actually the route map or the GPS for the future. GPS, in fact, is even an extension of further beyond the route map. GPS is more like a dashboard, which is current, which actually kind of compares where you are today versus what you had planned, right? So that's even beyond forward looking. But that is the basic those 2 are the 2 basic elements of your financial story. So the main thing really is for the founder to have the ability to tell their story with numbers. You might have a great technology or a great software application, or it could be a new drug that you're developing, or it could be a completely new concept, right? and there might be a lot of traction in terms of interest from potential customers, or it might be some innovative technology. You might actually hold IP, which shows how unique or innovative that technology is. But when you actually talk to investors, when you want to raise money, you need to be able to tell your story with numbers, right? So saying that something is innovative, or something that's going to change the world, I mean, it's fine. But investors want to know how they're going to actually make money, right? And for that, you need to quantify. And first of all, you need to be able to demonstrate how your innovation or your product or your technology can actually be monetized. So what is the real value that you're creating? And then provide some kind of time element to that, right? So how much time do you think it might take? What's your best guess, right? To actually monetize that value that is there. And then to be able to answer these questions, right? How much money is actually needed to create that value? How much time is needed? So for an investor, it's then they're actually able to relate how much do they need to invest in the business, and what kind of return they can get, right? So, and that's why it becomes really important to be able to present this very clearly. Now, like I said, I mean, this is not an accounting course, but one part that is important to understand is, and to be clear at a principles level, at a conceptual level, right? Is so there are three main financial statements. There are others that are more detailed, but these three are the main ones, right? Income statement, balance sheet, and cash flow. And that's what typically an investor would look at when they are doing financial analysis of your entire business, of your startup, as they when they want to decide whether they want to make an investment in the company, right? So it's obviously important to understand what these statements are, how they're actually prepared, but also how they interact with each other. And that's a part which sometimes is not well understood. And even unless you are inclined, so financially, sometimes it's a bit difficult to get, even when you do a course, right? But it's actually very critical to understand that, because if you don't, it's pretty obvious for an investor to spot that you don't actually understand these basic financial statements, and then that puts a bit of a question mark on your entire credibility. So credibility as not in terms of your software or your technology or innovation, but in your ability to monetize that innovation, that software, that technology, right? Because ultimately, people are going to invest money in that, and they expect a return. So that's the basic expectation that any investor would have, right? So three main statements, financial statements. Let's look at each of them very quickly at a principles level. Again, this is not a detailed class, but at a principles level, and let's understand how they actually interact with each other, right? And it's actually quite clear, when you pick up an annual report of a company where these statements are presented in detail, the same principles actually apply, right? You can do this exercise offline later. Like pick up an annual report of any company that's listed, and the same principles will apply, right? So let's look at these one by one. Okay, so income statement basically, very simplistically, right, shows you how much money you have made. This is typically for a period, right? So it could be for the past year, it could be for the past quarter or the past month, or it could be a projection for the future, again for different periods, monthly, quarterly, annual. Uh, but essentially, how much money have you made, which is the difference between your sales revenues from the product or service that you sold in that period, and how much money did you spend in that period. Okay. Now, obviously, there is a lot of detail, and some of that detail we will cover in the next section, those details that are relevant. But at a simplistic level, how much money did you make in the past period? Or if you're talking about the future, if it's a projection, how much money do you expect to make, right? So you're making, for the future, you're making assumptions. You're making assumptions on the revenue, right? You're making assumptions on the expenses, the costs that you think you might incur to generate those revenues. And therefore, what net income would you expect to make, right? So obviously, these are, imagine if you will, headline figures, right? There are a lot of detailed lines which you don't see here. But if you imagine that there is a button there with a plus sign, and you tap on that, and it actually opens up and shows you that there are 10 lines within each, right? Possible, right? But at a simplistic level, how much money did you make, or do you expect to make, right? So that's what your income statement is, and it is for a period. Remember that, right? Let's look at the next one. The balance sheet is really an account of your assets and your liabilities, right? And this is a snapshot. So it's typically a snapshot, and typically the way to present it in any financial statement would be to present the snapshot at the beginning of the year and then at the end of the year, so that when you compare the two, you actually see what's happened during the year. So has the business grown? Have the assets in? So and there is a lot of insight, a lot of detail that you can get into, with each of these groups, right? Assets are basically, as the name, as that word indicates, something that is of value, right? Which you are holding. And this can actually be money, that's cash that's in your bank account. So this could be money that you raised, let's say, from investors, or it could be money that you have put into your own business, and you deposited that cash in your bank for your business. And then there can be other kinds of assets which are actually not money, that they're not cash, but they are assets which at some point will get converted to cash, right? But so they're something of value, right? So so examples could be it could be inventory, that you might have bought, or it could be money that you have invested in developing a product. You're working, let's say you spent the past year building a technology. So you spent a lot of time, money, effort, labor in building that technology, maybe in the lab or in a workshop. So you actually spent real money, right? But that money, you've not yet sold the product. But though that money has been spent, it's an asset that you've created, because you expect to get value from that asset sometime in the future, right? That's an example. Another example could be, you might actually hold some patents, right? Or you might have bought, let's say, the rights to use a certain technology, right? And that's an asset. So anything that is either that is of value today or what you expect to get converted to value tomorrow will be an asset, right? So that's what you find. So that's what is here. And typically the division, the separation is cash and other assets. So cash is basically anything that is liquid, right? It's money in the bank. It can also mean, things like if you've already, let's say you've already sold some products to customers but you've not got the money yet. So that money is expected, the payment is expected from them. That is also an asset, right? So that's typically accounts receivable. So that's seen here as well. So that's the asset side of your balance sheet. The other side is basically liabilities, which is any ways that you're actually funding the business in summary, right? So this would be, so all the money that you raise from investors, any money that you put in would be seen here. It will also have loans that you might have taken from banks. It might also have things like accounts payable. So accounts payable actually acts like a financing for the business, because what you're basically doing is when you buy something from a vendor and you tell the vendor that, hey, payment terms, and the vendor payment terms, let's say, are 30 days, which means I buy whatever, whatever I'm using, I buy it today, but I'm paying for it only after 30 days, right? So for those 30 days, I'm kind of, the vendor is basically financing me, in a way, in a small way. It typically is not a large part of the financing, but it is financing basically, right? So all these actually form liabilities. And then there is retained earnings. Retained earnings is basically the earnings that basically it's the cumulative income that the business has actually earned over its life, which it hasn't distributed to investors yet. So it's actually sitting in the business. It's not taken out yet, but it appears on the liability side because though it is money, it appears on the liability side because that earning is basically due to the investors. It's investors' money, right? So investors have put in capital, and then there is capital that they have not withdrawn yet. So that's basically retained earnings. So you'll notice that the total assets and the total liabilities, they match, right? I mean, 450, 450. Similarly, you'll see the snapshot at the end of the year. Again, the total assets 510, total liabilities 510. Again, they match, and that's like a cardinal rule, right? Of the balance sheet. The assets and the liabilities have to match, right? Also, what you'll notice is cash and other assets both have increased, right? And that's resulted in the increase in the total assets, right? I mean, you can do the math. Numbers are here. Similarly, liabilities have gone up. Paid in capital is the contribution from investors, right? The money that they've invested. So that has actually not increased. That's remained the same, which basically means this company has not raised funds during the year, right? However, retained earnings have actually gone up from 100 to 130. Now, if you go back, and now I'm going to try and relate the different parts of how they're actually connected, right? So retained earnings, like I said earlier, is basically the earnings in the business, right? In this year, so the net income was actually 40 for this period, right? If you remember, but the retained earnings have gone up only by 30. So what's happening here? So let's see what's happened. Um, the third important statement is the cash flow statement, and typically it is generated typically from the other two statements. So it's a derivative, right? So so there are two ways actually. One is to basically just look at two ways to generate the cash flow statement. One is to just look at the cash in and cash out from your bank account. So any money that comes in, let's say payments from customers, or could be you raise money from investors, uh, could be because you have certain bank deposits, you're earning interest in that on that. So that is money in the bank. So different ways in which money is actually flowing into your bank account, and then money is flowing out as well. You're paying salaries, you're paying your vendors, let's say because you're paying rent, these kind of things, right? So net, how much money you started with, what money came in, what went out, and what you were left with. So that's one way. So there are two. So that's one way how the cash flow statement is prepared. The other way is a derived or indirect way, which is using the income statement and balance sheet figures to come up with the same numbers. You end up with the same flow. There's no difference. There's just two ways to get it, right? And the way to actually check whether these statements are accurate or not is basically just to look at your bank account. So at the beginning of the period, let's say the period was 1 year, 1st Jan of the year, what was my balance in my account? Assuming I have only one account, so that's what I'm looking at. And at the end of the year, what is my balance, right? So the year-end snapshot from the balance sheet at the end of the year. So that really shows, so those figures at the beginning and at the end should match. So whether you use the direct or the indirect method to make the cash flow statement, those figures should actually match, right? The beginning year cash and the end year cash. And that's how they're actually related, right? So if you see the income statement, what we saw in the beginning, where I had revenues of 125, expenses of 85, net income of 40, right? Out of this 40, there was a dividend of 10 that was paid. And therefore my cumulative, so retained earnings, like I said, is the cumulative earning from that business. So beginning balance was 100. What I earned during the year was 40 from the net income, but I paid dividends of 10. So what I'm left with at the end of the year is 130. And that's what actually goes into the balance sheet. That's the figure that you see here, 130. Similarly, the cash at the beginning of the year, which is 100, is used here in the cash flow, the indirect cash flow statement to determine end year cash, which actually you see at the end of the year in the balance sheet at the end of the year, and which also matches the balance in your account at the end of the year, right? So that's the connection between the balance sheet and the cash flow and the income statement as well, right? So that is the basic sort of mechanics of how these different statements interact with each other. And I mean, I would suggest everyone to do this exercise of picking up an annual report, and any company that is listed, doesn't matter Indian or otherwise, to actually see for yourself how these numbers actually move over the years, right? So I'm going to take a quick pause here because this is a lot, to digest, especially for those who've not seen these statements before. And there is a lot of detail which I don't want to actually cover at this point because it's not that relevant at this stage, for this group, right? But I want to pause here and just check if anyone has any questions or about how these actually work. because we'll build on this for when we go to the next next part of today's session.
Couple of questions, Alankar. Again, I'm not from the finance background, so probably that's why. I'm not sure. I did not understand why retained earnings would be a liability. I mean, it's earning, and you're still saying it's a liability.
Okay, good question.
And second, one more question, right? Yeah. I think I forgot. Anyway, let's work on this, and then I was thinking about it.
Okay, sorry about that. Probably I made you forget your second question. Hopefully it'll come back. It's a very good question. So some of this seems counterintuitive, right? So the words actually seem to mean something else than what they say, right? So retained earnings is actually one such example where because so anything that is due to somebody will appear on the liability side of your balance sheet. And that's why, so the retained earnings, so the question to really ask is, who owns these earnings, right? It is actually the investors who put in the money into the company, and they have actually got the return on their investment. And that's the money that's left actually in the business. So let's say tomorrow we decide to actually shut this company down for whatever reason. That's the money that the investors will actually take out of the company. And that's the reason why they appear in liabilities, because they're actually not owned by the company per se. They are actually, owned on account of or on behalf of the investors, right? So anything that is due to somebody else will appear on the liability side. Essentially, it's a way of funding the business. And also look at it this way: whatever money that you don't take out of the business. So companies that make a lot of profits, you have big established companies that are extremely profitable. They pay dividends, but they retain. They don't. They might not pay all of the money that they've earned as dividends. They might retain actually a substantial bit with the company, with the intent that they want to make investments in the future. So in the future, they might want to, let's say, expand or into new products or new markets, and for that they need money, and they would actually use these retained earnings to fund that growth in the future, right? Because that growth has to be funded from somewhere, and the only way, actually, the only few ways in which you can fund it. I mean, you can either go and seek capital from outside by going to investors or to banks, or you can use the past profits that you've made, but you've not taken out of the business, right? And that's why they are actually called retained earnings, because they are earnings that are retained within the business and not distributed to investors. They're retained for future growth. So it sounds counterintuitive, seems counterintuitive, but it's actually a liability. So hope that helps.
Yeah. And then second question, I just remember the other assets. So you said, like, let's say we are developing certain technology and we are putting money in it, but the technology is not totally ready yet. How do we put value to it? I mean, are we supposed to put value to it in the other assets?
Very good question. So let's take your example, right? So let's say from the beginning of the year, so we are in September now, right? 9 months of the year have gone. In the past 9 months, so let's say you have actually spent money, right? In maybe you're building a prototype in your lab or in your workshop, right? Yeah. Mm-hmm. Of the battery that you want to sell in the future, right? Mm-hmm. So you spend money actually fabricating that damn thing, right? You bought components from different places. You have maybe hired some engineers to work in your lab,
Mm-hmm.
and you paid them salaries, right? So you paid your engineers salaries, you paid your vendors, because maybe you bought some circuits and some other equipment to components to make to develop your battery, right?
Mm-hmm.
And maybe you in the first 3 months, first quarter, you tried one design and you tested it, and you spend money in testing as well, right? So anything that you do, it's all extremely capital intensive, right? So you're spending a lot of money. You tested your first design, it didn't really work, it failed the test. You made some tweaks in your design. You had to buy some more components. You made your second design. So in a sense, you spend more money, right? So you've spent and you spent and you spent.
Mm-hmm.
But you've not got any return. Nobody has bought that from you, right? That battery from you.
Mm-hmm.
The first battery that you designed in your lab, actually, let's say it failed your testing.
Mm-hmm.
So no customer is actually going to buy that. I mean, you have no hope of actually selling that battery, right? Specifically.
Correct.
But the knowledge that you've gained, right? The insights that you've gained from that first failure, right, have actually improved your second design,
Mm-hmm.
right? And there is value in that, and that's actually essentially the IP that you're creating, right? I mean, the innovation, the intellectual property that comes from this trial and error, this application of knowledge and learning from that experience, right? And the more you do it, the better you get at it. And finally, you will maybe at the end of the year, when you're on version 3 or 4 or 5 of your battery, you might be finally have a design that you're confident of launching and taking to a customer, right, and selling it, right? But during the year, you spent a lot of money on all these different versions, and so argument's sake, right? So let's say you spend 50 lakh rupees in the year on all these different versions, and your first battery that you're finally confident of selling to your customer, which is, let's say, at the end of the year, you actually finally build it. You've already spent 50 lakhs developing that battery. Essentially, during the year, you spent 50 lakhs. Is your customer actually going to buy it for 50 lakhs?
No.
No, right? Your price point is probably 10,000 rupees or 20,000 or whatever the price point you might have, maybe 50,000 rupees, right? You actually spent 50 lakhs on your battery to develop it, but just one battery, by the way. But your price realization from that one battery is going to be only 50,000 rupees. But in the future, you're going to make a lot more money by selling a large volume of those batteries to your customer and many other customers as well, right? So your ability to repeatedly, because your design is finalized and it works, you know that it serves the purpose, serves the requirements. All you need to do now is to manufacture, right? There is no uncertainty from a design point of view. So you go ahead and start manufacturing, or you license the technology out, whatever it might be, right? So the value that you get is actually from repeatedly selling large volumes to your customers in the future, right? What allows you to do that? The fact that you spent 1 year struggling in the lab, had 5 versions of that battery, and you spent 50 lakhs on it, right?
Mm-hmm.
So that's the value. So that's the asset that you've created, right? So though it is money that you spent already, it is actually an asset, and therefore on the balance sheet, it will be actually shown under on the asset side, and under other assets, which are typically illiquid assets, or basically anything that cannot be converted to cash quickly, right? And that would be the value, and you would typically there are rules to capitalize this asset over a period of time. So basically meaning that 50 lakhs that you spent on designing the battery in the first year, if you sell, let's say, 10,000 batteries over the next 5 years or 10 years, let's say 5 years, right? Then you might be able to apportion. That's what capitalization actually means. The 50 lakhs that you already spent in the first year, you are able to apportion that to those 10,000 batteries that you're going to sell in the next next 5 years. Why is it 5 years? And it could be 5 years, it could be 2 years, depending on the life of that asset. And what does that depend on? You are in a very high tech industry where things become obsolete pretty quickly. So maybe in 2 years or 3 years time, there might be a new technology, right? Or you yourself might come up with an advancement, right? A new generation of batteries, right? And the version 1 that you launched after year 1 might become obsolete, right? So the 50 lakhs that you spent in developing that first battery, you need to kind of recover those 50 lakhs in that 2 or 3 or 5 year period, in which you might sell, let's say, 10,000, right? And that's actually the capitalization. So in the balance sheet, this capital asset of or IP, you can even call it IP, of 50 lakhs, then gets used over the next 3 years or 5 years, whatever that period might be, in which you're actually selling this battery. And that's where that depreciation or amortization actually comes from. All these terms that you find in any income statement, right?
Okay, yeah, that makes sense.
So, and then there are more complexities around that. You can create a tax asset. There are many other things around that. But at a principles level, what you need to basically understand, and it's sufficient actually, is that the money that I'm investing in building some knowledge or some expertise that has value, which I will recover, let's say, over a period of time by selling to my customers, that becomes an asset. The money that I've spent, that becomes an asset, and that asset will then be capitalized over that period, right? I mean, at the principles level, it's fine if you understand this much. Everything else is a matter of detail.
Alankar, this is Madhav. I may be allowed to just append on what you said.
Sorry, is that Madhav?
Yeah, that's Madhav. That's Madhav.
Yeah, go on, Madhav.
Yeah. So Ritujin team, I just append what Alankar was explaining. Try to give you a different flavor. So first, your question was, how do I identify why retained earning is my liability? So the first rule for all of you is that treat your business as an artificial individual. So all of us are natural individuals. But the moment you consider your business as an individual, artificial individual, that business also has a characteristics of behavior. And the moment it is an artificial individual, who does that money belong to? If the answer from the point of view of your business that this money belongs to investors, immediately that becomes a liability for that artificial individual called business. So when you want to find out whether this is an asset or this is a liability, don't think the Rutuj as an individual. Think as your business as individual. And the moment you do that, you will start getting answers why certain things are liabilities or why certain things are assets. Does it help, Rutuj? I mean, then you separate out you as an individual from your business as an individual.
Correct. Okay. Yeah, it does that.
Okay. So it's simple. So you have to just think, is it Rutuj asking this question or is it your business asking this question? If it is business asking the question, the exact answer will go from one side to other side, left to right and north to south. That's one. And second, on just what Alankar was explaining about the assets and other type of assets, again, try to use a simple word. Asset is an opportunity to either quantify or write off based on the potential of it or based on if it is going to fetch you anything or not. So again, use the simple rule that the example Alankar was giving, you are today putting in a lot of money. It is still not converted into asset till it has a potential to earn anything in turn. So give you an example. Unless your building is completely constructed and you have a possession certificate or a completion certificate from an authority, it is not an asset because it is not fetching you anything. Till that point of time, it is only an investment, but it is still a value. You have to still record it in your balance sheet because you have spent that money, but you have not earned anything out of it. The moment that building is complete, you can sell shops, you can sell flats, you can do whatever, and you can start getting money out of it. So your rule is very simple. Till you get your money generated out of the investment you have made, it has to still appear in your balance sheet, and that's where you will account it for in other assets or whichever category. The moment it starts getting cash for you, that becomes an asset, and then you can convert it either into your IP or whatever, or your software, license it out. There are different ways of it. I'm not going to overcomplicate it. Alankar has already given a lot of explanation, but I thought maybe a different point of view to help people to understand accounting jargons. I hope it helps.
Yes, sure. Thank you. Thanks a lot, man.
Thanks for that, Madhav. But just to reinforce one point,
Yeah.
and just to make sure that there's no confusion on this, right? Even an investment actually is an asset. Okay, it's just a different kind of asset, right? So here you see only cash and other assets. It's a oversimplified representation, right? Because the purpose of this representation is something else, to show you how the different parts actually interact, right? The purpose is not to look at the income statement, but there can be many kinds of assets, right? Investments that you make, property that you buy could be an asset. If you buy a patent, that could be an asset. If you, let's say you have created, let's say you've manufactured some batteries, Rutuj, but you've not sold them yet. So they're lying, they're actually lying in your factory or your godown. That's an asset. You might have actually, let's say, ordered components from different vendors. They've actually already delivered those components to your factory and they're lying in your factory. That's an asset as well. Because it's going to get converted to money at some point, because it's going to get converted to your final product, which you will sell to your customer, which will get you money, right? So like Madhav said, anything that's an opportunity to create money or create value in the future is actually an asset, right?
Okay, yeah.
Anything else?
Hi, Alankar. Samudra here. I have a few questions to ask.
Yeah.
So, my first question is in continuation with what Rutuj asked. So, I had been always in discussion with my CA that we are building a platform and that should be part of the asset. However, it is not being shown at this point of time. Now, this platform is helping us earning money, and every year there is a huge investment we are putting across in terms of the salaries only, in terms of the outsource that we go. Now, as in when we are growing as an organization and building this platform, our idea had been that the platform as an asset, the value should go on increasing. How do we calculate it? Because my CA says, I don't know how to calculate it. I went to some experts. They said this is a fictional value. We can't calculate it. But what should be an absolute way to calculate the value for a platform which is growing? If there are users, if the buyers are paying you in ARR, MRR, and all those components.
Right. So good question. So see, what happens is there are actually accounting standards, okay, that pretty much spell out how these calculations are done, what the treatment should be, okay, and that's what actually chartered accountants will follow typically, right? Because when you're presenting a figure in a certain way and you're, let's say, talking to investors or to any stakeholder, and then you're saying that these statements have been prepared based on Indian GAAP, or it could be IFRS or US GAAP. You're basically saying that there is a standard that has been used, which basically means that the treatment or the definition of what is an asset, how do you actually value it, All these are actually defined, right? Now, in the case of startups, it becomes a little bit more complicated because, at the early stage, literally everything that you're doing, right, is money that you're spending into something that you hope will have value in the future. You don't know definitely if it will, but you hope that it will, right? I mean, if you were PNG and you were, let's say, making, I don't know, shaving foam, there is almost like a guarantee that you'll be able to sell that product once it reaches the shelves, right, in the supermarkets. But because the product is already developed, there is no uncertainty at the design level, right? But for startups, you might keep trying. You might, before you figure out the right model or the right product, which is actually going to make money, right? And that's why timing is so important, right? The sooner you do it, the faster you do it, the faster you reach product market fit, the faster you are able to monetize that asset, right? So in terms of, if your CA is saying that he's confused and he doesn't understand how, I would suggest talk to a more experienced CA. I mean, that's my very simple, suggestion to you. Mm-hmm. Offline, we can talk about specifics of, your case, because it will depend on what the specifics are. Okay.
True that.
Because what happens is, like, in your situation, you've already done a fair bit of revenue. You're ahead of some of the other teams here, right? You've done a fair bit of revenue already.
Right.
Now, when you're in that mode, there is a separation that you need to do of the money that you're spending on design versus delivery.
Mm-hmm.
Right? So the money, let's say that the salaries that your business, the main component, the expense is going to be people, right? I mean, that's the main one. Other than some IT infra type expenditure, which will be a small portion, the biggest portion will be salaries, right?
Right.
Take yourself back 2 years when you were, or a year and a half when you were starting, you didn't have any revenues, right?
Right.
At that time, all the salaries that you were paying, you might have had a smaller team, all the salaries you were paying, the work that those people were doing, all that work was going into designing your product.
Right.
And testing and piloting and talking to customers, doing marketing, all of that. Right. Whereas today, there is a fair, maybe half or maybe even more than half of the salaries that you're paying, half your team might actually be involved in the delivery side.
Right.
Right. So 2 years ago, all the money that you were spending on salaries, I mean, would be capitalized. It'll become an asset on your balance sheet. Whereas today, let's say the split is 50-50, 50% of your salary, of your people, of your time, of your team's time is going into, let's say, delivery of projects. That's a direct cost, which will appear on the income statement. It will not go onto the balance sheet. But if you have an internal team, let's say, where you're building some new concepts, you're building some new products, you're seeing a pipeline. Mm-hmm. Your customers are telling you, hey, can you also do this for me? Right. Right. And you're trying to, and then you try to allocate, okay, this team or this team member will actually focus only on this new project. Mm-hmm. So all that money that you're spending and anything that you're spending on new products development will actually be on the balance sheet. It will not hit the income statement till you start selling that product, and then somebody is helping you deliver that product. Right.
Right.
So in principle, actually, it's not difficult at all. So I don't understand why your accountant is confused. There must be some nuance, some detail, which makes it more complicated. So which we can discuss separately. That topic is not for this session. So
not an issue.
But I hope I've answered your question, right? At a principles level, at least.
Right. My second question, which is related with more on the cash flow projections. As you go as a platform, there are ARR and MRR projections which you have in your mind, but there is always a fair bit of dropout in the percentage. So when I'm giving a projection cash flow of, say, next half year, I know that there are certain percentage of people who are going to renew it, but sometimes they drop out. how does it impact the balance sheet to people who are reading for the future times?
Okay, so a projection by definition, okay, so whether it is ARR, MRR, whether it is sales revenue, it actually doesn't matter what you're projecting. Basically, you're projecting in the future based on certain assumptions you make today, right? Based on your best understanding of what the future might be, right? So based on, let's say today, you're having lots of sales conversations with your pipeline. So you have some understanding of, I'm talking to, let's say 30 people, 30 potential customers. And based on your assessment, you make an assessment that the probability that some of them will convert and at what price point and at what volume point they might convert. So based on that, you prepare a projection, right? Of your revenue, of your cash flow, AR, all those metrics. Now, in reality, what happens it will be different from what you projected.
Right.
It will be different from what you projected. So if you were, let's say at the time of projection, so let's say you had an investor meeting and you were going to an investor meeting and you were super optimistic about your projections because you wanted to show, I don't know, certain valuation or you wanted to show a very optimistic picture about your business. You would, your assumptions are, let's say, extremely, they're on the extreme side. And on the basis of that, you might actually even get the money. Let's say if you're able to convince the investor. But as you start actually running the business, and let's say you realize that my targets are actually not being met in terms of revenue, in terms of ARR, MRR, sales, and so on. What you'll notice is that, so basically everything will change based on what you're actually presenting, what you're actually doing, operating, right, at the operating level. So for the balance sheet, what it will mean is if you were too aggressive in making estimations of your sales, let's say, let's say you planned on the basis of, let's say, a unit of 100 of sales, right? But you ended up doing only 50. So the implication of that for your balance sheet will be the money that you raised is going to last you longer than what you thought, right? It's not necessarily a good thing, but it's more comfortable. On the other hand, if you, let's say you underestimated your growth potential and you much to your surprise, did a big sale, which was not expected at all, you can actually run out of money because you don't have enough, you've not raised enough funds. And then you need to go back to your investor and tell them, hey, I've got, I thought I would do 50% month on month, but I've actually done 150% month on month in the last 3 months and I'm out of money. So I want to do another raise, right? And that's a good problem to have actually. So again, I'm saying this, I'm, responding more at a principles level. At the detail level, obviously, the different elements of the balance sheet will get impacted in different ways, right? If your customers decide to pay you or pay you later than what you thought, you will need more money. You will run out of money. If your vendors, if they start demanding payment from you earlier than what you thought, you will run out of money. So it's all about basically matching or trying to, so on the one hand, you are kind of getting money in, which comes from your customers. And on the other hand, you're spending money, which goes to your, for salaries, for vendors and all of that. And both of these are moving at, it's like they're moving at different speeds. And any gap between the two, you need to fulfill by the cash on hand that you have. Right?
Right.
So hope that answers your question.
Yeah, very much. And
details you can get into later.
Right. I just asked one question again.
Yeah.
So, for example, today people use our platform and they give us equity in barter. They don't have money to buy the product, but they say, okay, fine, we will give you, and we make some decisions and calls that, okay, fine, we are happy to give our platform. In that case, we hold more than 26% of the equity in the other company, whoever is going to use the platform. How does it impact my balance sheet in the future?
Okay, I would tell you, tread very carefully. Okay,
Okay.
because you cannot eat equity. By that, what I mean is that for you to grow your business at a certain rate, you need to have a certain level of spending, right? And this is real money that you're spending on, let's say salaries. Let's say you're paying salaries to your engineers, and let's say you get a big contract, you need to hire 10 more people, you'll need to pay them real salaries, right? If you want to reach out to many more of your customers, you have to spend a lot more money on marketing. That's real money. That's equity is not going to help you. So if I was you, I would try and kind of minimize my exposure. See, having a small amount that is convertible, that's basically not cash, is okay. But I would say a very small part. See, startups by definition are illiquid. There is no money, right? So when it comes to you running your business, obviously you should try and get as much cash and conserve as much cash as possible, as a rule, right? Because if you have too many of these cases where people say, oh, we can't pay you, but here are shares, the business might collapse at some point.
True that. So we collect cash. So for example, X is the price of our proposal. We end up doing it 0.4x, 0.5x, and the rest of the thing we get converted into equity part. So cash we collect, which is the cost to us plus some X percentage of buffer and profit what we keep it, and in the financial calculations. But apart from that, we try to take some equity in that part also.
So what you're saying is you're building in some kind of, so there is some kind of calculation behind it. It's not blind, right? And
No.
it's good that it is that way. But let me also tell you that I would still say try
Right.
not to do it. Okay.
Okay.
Simply because 40% cash and remaining 60% in equity, the financial risk of that and the cash flow risk to you is so high, because 60% of the value that of your sale, if that success rates for startups are 5% or lower. Okay.
Mm-hmm.
So if I was an investor, what I would do is I would take a 5% probability of you actually making, you actually collecting on that cash. Okay.
Got it.
So, and therefore the value of what you sold is not 100, it is just 45 or 40. So I, as an investor, I would completely discount what you have, the value of that investment, right? Because as far as I'm concerned, you're never going to get it, or it might be 10 years before you actually get it, before you're able to monetize. So as a startup, please don't get into these things. It's very tempting. It actually, for a customer, it works really well. And especially if they're also a startup, then it works really well because they're conserving cash. So I would strongly advise you, don't do that.
Sure, we'll take your point. Yeah, that's all my questions. Thanks.
Okay, so
Alankar, Jaideep here.
Sorry, who was that?
Jaideep here, Alankar.
Yes, Jaideep, go on.
Yeah, specifically one query from early stage startup point of view. Most of these three statements, which is income statement, cash flow statement, and balance sheet, would be purely a guesswork on future work or projections which we will be doing. How much investor will discount it when we go for fundraise? Because there is a high possibility that in order to get better equity in the company, they will try and do more of a discounting, and they will not give the necessary weightage to the gut feel or the projections given by the founders. So what's the right way of doing it? If you can share some insights on it, that would be really helpful.
Okay, so that's a great question. And I think, and this question actually relevant, important to all the teams, right? So first things first, it is a projection, absolutely. And there is a heavy discounting that is done by any investor. Okay. No investor worth their salt will actually believe what you're projecting, right? So while you might have put in a lot of thought, a lot of work, a lot of effort, ground up estimates, you might have done a lot of work, and you have the conviction that that what I'm presenting is achievable, right? No serious investor will actually believe that. Okay, they will discount it. Okay, but the important message in this, okay, is that what you're actually demonstrating by showing these projections and showing the details, showing how you've come up with these projections, what effort has gone in, what assumptions have you made. What you're demonstrating through this is that you understand what you're doing to the best of your ability, and you've done a lot of work, right? And that is what you're trying to demonstrate, not the fact that the revenue is going to be X or the number of customers are going to be Y, because those nobody can predict. Everyone knows that that numbers will never be hit. If you remember what Nikhil said last week in his talk, right? He's done 4 or 5 startups. Every single startup, his experience has been whatever business model, whatever projection, whatever they came up with at the beginning was completely different from what they actually ended up with, right? In reality. And that's the rule. That's not the exception, right? So then the question, maybe Jaideep, that you haven't asked, or that's probably a silent question, is then why do this? What is the point? If nobody believes my projections, and anyway they are not going to happen according to what I'm projecting, reality is going to be very different. What is the use? Why am I doing this? Right? The use, the purpose of actually doing this is 2 things. One is, to demonstrate that you've done the work, that you understand at a very great level of detail how, what are the different aspects of your business model, and financially what the implications of those parameters are, and how these different financial statements, projections actually interact with each other. Because ultimately, how much money you raise or you might want to raise, the answer will need to come from this projection, however inaccurate it might be, right? But that is better than a complete guess. That's better than saying, oh, you give me 2 crores and then I'll see what I'll do with it, right? I mean, you'll get laughed out, right? But when you go to an investor saying, I need 2 crores, and this is the reason I believe that 2 crores is a good amount for me for the next 18 months. And this is my story. This is how I believe my business will actually grow. And that's why I think 2 crores is a good number to aim for. And then the discussion is more around, the debate, the discussion is more around, what's your business model? What assumptions have you made? Are they realistic? So all these, many checks can be done, right? To figure out whether you are being overly optimistic or you don't know what you're talking about, right? And that's the whole due diligence process, right? So you can't get away from doing the detailed work on this, because if you're not able to demonstrate this, you don't have any credibility with the investor, because then they have no confidence in your ability to actually execute on what you're saying you will execute, or what you might be painting a big picture. Oh, there's such a big opportunity, right? I can do this, I can do that. But can you really execute on that? And can that make money? Right? I mean, so it's almost like a head fake. Head fake is it's a term that I read about. It's in baseball actually, where you're actually signaling one way, but that is actually to trick the people who are looking at you, but it means something else. So it's a little bit like that, right? So the process of going through it is what is important, not what numbers you actually end up with. Because if you don't go through that process, then you'll not be taken seriously by any investor.
Yeah, Alankar, can I add something to that? This is Sanjay Bhandari. Yes, so Jaideep, to answer your question, as a founder, you are going to project certain revenue or projections of the revenue. The investor is going to ask you for your pipeline of customers. And for each of the customers, they're going to ask you to say, what's the revenue, what's the upside, what's the downside. So they'll look at both the sides of upside as well as downside. That's number one. The second thing, they're going to ask you to give reference of the top 3 or top 5 customers. And the investor will personally make a call and talk to each of these investors to figure out their own perception or judgment in terms of how real this revenue is going to be. And a combination of those two, they'll come up with their own model in terms of that projection that you have done. So that's their due diligence, and that's how they are going to come up with the valuation.
Absolutely.
Got it.
Thanks.
Thank you, Sanjay ji. Thank you.
I'm actually going to move on. There is a bit more to cover. Any other questions we can take offline? Yeah. Because there is actually the content. We're trying to cover a very large area, right? In a quite a small amount of time. So I appreciate that there might be more questions, and I'll take them offline. Otherwise, we won't be able to finish what I planned today. Okay. So now talking more specifically about your pitch deck, because this is what you are actually going to make or you're working on already, right? And the financial slide in your pitch deck is actually one of the most important slides because it kind of ties, it tells your story of your entire startup with numbers, right? And makes it interesting for the investor, because ultimately the investor wants to know what's in it for me. If I give you X amount of money, when will I recover that back? Or how many times my investment will I make over a reasonable time period of time, right? So very critical that you get this right. So let me show you 3 financial statements on one page. Any thoughts about this from the group? Any comments? This kind of shows how the interaction is between different parts. You have the income statement at the top, then you have the balance sheet, and then the cash flow at the bottom. And it's kind of showing you how the numbers actually interact, what we discussed in the earlier part of the session. So what I want is everyone to look at this and tell me what they think. The first 1 or 2 thoughts that come to there. This is not about analyzing the financial statements. It's about what do you think when you see this? Let's do a quick survey. Who wants to go first?
Multi-year projections in one slide.
Sorry?
Multi-year projections in one slide.
Multi-year. Okay. So maybe too many years. Okay. What else?
It's just too much information in a single page. So it's not easy to read.
I'm hearing it's not easy to read. It's too much stuff in one page. Okay. What else?
The representation.
Can I try?
Sorry, what was that?
Alankar, this is Amol. Can I try?
Yeah. Please go ahead.
I think the company is making it is kind of a platform which has invested initially and then it is earning at the latter stages of the company.
No, don't get into what it means. Tell me when you see this, tell me what the first thought that comes to your head. Don't analyze the numbers. That comes later.
Okay.
Alankar Samudra here. It's too complicated.
Too complicated. Actually, okay. So maybe some of you are being very polite because this is my slide and you're not actually saying what you actually want to say. So let me actually say those things, right? I actually can't even read. It's in front of me, but I can't even read what's there, right, on this slide. And some of these things have been said already. Too much information, too complicated, too many years, multi-year, too many lines, right? Too much information, Also, if you notice, I can't even read the words because they appear, it's like they've got stretched horizontally, right? Yeah, so it's incredibly difficult to read, right? Now imagine if the slide from your pitch deck, which had the financials, imagine if that slide looked like this, and what your investor would think, potential investor. I have seen hundreds of pitch decks, and these kind of slides, right? If I see something like this, I will not even, I will straight away, it's a no, right? I will not even go in to make the effort of looking at the numbers. Because what this tells me is that you as a founder don't even know what is important, right? You just dumped an Excel sheet and you want me to then figure out what is important to you, right? It's lazy. You're taking me for granted. It looks ugly. It is not even legible, right? So there are many things going on here which will piss off any serious investor, right? So let's see how. So in design, so whether it is architecture, whether it's product design, there's always this thing, form versus function, right? And different schools of thought, right? Typically, oldest one has been, form follows function, right? And so on, right? Now, what does this actually show you? On the left, you see a clean, both of them are watches, obviously, they're showing you the time. The purpose actually is to show you the time. The one on the left is very simple, is very elegant, right? Looks very nice. The one on the right is a lot more complicated. There are many dials, and both of them are expensive watches, by the way, right? The one on the right has, you will see, it is not that obvious, but it actually has a tachymeter. So tachometer is basically, it tells you the speed at which you're going, right? So, and then there are some other dials as well, which are giving you other information, right? So what you must understand is both of these are watches. They are expensive watches, they're great watches, but who are they made for? So if you were, let's say, a race car enthusiast, or if you were a pilot, or you like Formula One, and let's say you go to a Formula One race, then the one on the right probably you probably would go for the one on the right? But if you are out for a nice, elegant sort of white tie event, black tie event, and or a nice dinner or date or whatever, you want to wear something elegant, which it just tells you the time, it looks nice, which is the one on the left, right? So it is always important to have this at the back of your mind when you present anything, not just financial statements. It becomes even more critical for financial statements because you can potentially give out a lot more information than is needed, or that or that might be actually even for your own good, right? You don't necessarily want to share all the information. So always keep this picture at the back of your mind, right? So form and function, I believe they both go together, right? So what not to do, right? Borrowing from Sanjeev's new book, illegible. So we saw all this in the previous one page, 3 financial statements in one page that we saw here, right? Illegible, too busy. You have too many numbers, words, digits, commas, decimals also important. We have a habit of, right? So, if your number is very big, it is important to actually summarize those numbers, right? Put them in millions, or put them in thousands, or put them in, so that the number looks legible. I mean, there's no point putting 8 digits in your, so imagine there are 6 columns and each column has 8 digits. I will never be able to read what that, I'll always be counting, right? So same thing with decimals. In a summary level balance sheet or a financial statement, decimals have no place, right? What is the size of, or there are too many kinds of fonts, right? Or there are too many colors which are distracting. the font size is too small. There's too much information. There are too many messages, right? So there is lots that can go wrong as far as the form is concerned, as far as just the look and feel is concerned, right? Similarly, so if you can get beyond this, beyond the form, because that's the first impression, then you come to actually function, right? Which is a little bit more involved. I'm very quickly going to run through this, but and it's there for reference for everyone later, right? But when it comes to function, what is the purpose of your financial projections? It's to tell the story of what you think how you think your business will grow for the future, right? So if your assumptions in that your business model or your financial model are illogical or they are unrealistic, that doesn't help you. Similarly, things like costs not growing proportionally with revenues. Again, direct costs should grow directly proportionally to your revenues, whereas indirect costs should not. Indirect costs could be fixed costs. So initially they might be a very high part of your percentage wise of your revenue, but later on it should taper, right? I mean, these are just hygiene checks, right? That will be apparent as you go. Similarly, headcount should grow, but not proportionally, because if you are you're not in the people business, you're in the technology business. If your headcount is directly proportional to your revenue, then you're in a services business. You're not in the tech business, right? Similarly, revenue per employee. There are certain metrics which people will calculate based on what you're presenting, right? So your revenue per employee, profit per employee, what are you actually saying? So you might say that in year 3, I expect my revenues to be $5 million, let's say, right? And then below and when somebody asks you that question, how many people, what's your projected headcount in year 3? And then you say, oh, I'm going to have 5 people, right? In year 3. And if your projected revenue is $5 million, what you're basically saying is your revenue per employee is $1 million, which is more than Microsoft, which is never going to happen, right? So these are the kind of checks that people will do, right? I mean, COGS, gross margins have to be in line with norms. And all this actually needs to be, consistent with what you're actually presenting across different statements, right? And it impacts how much money you're actually raising. So, again, I'm not going to get into detail of this quickly. I can take questions later. So basically what is important is, so there are certain things which are critical to show on your summary. And now I'm coming to what you actually need to show, right? In your summary financial slide, right? So 4 things, basically. Principal level, 4 things, right? So some key metrics, some KPIs, or some like Madhav covered last week, some maybe your North Star metric and some key metrics, right? And these are going to be different for different companies, for different teams. So for some, it might be, the number of customers, some it might be ARR, MRR for your SaaS kind of businesses. For social media and these kind of businesses, it might be number of active users, because you might not have revenue initially, and so on, right? So some key metrics. Also, you'll notice that you see how the periods are shown, right? So the closest period is shown month-wise for the first quarter. Then it's quarter-wise, and then what you don't see in the future is actually, so this is for year 1, and then you see year 2, year 3, year 4. Beyond that, beyond that doesn't really make sense. Till year 3, year 4 is okay. Beyond that doesn't it's not really meaningful. But essentially the timeline, what you're showing is that in the next year, I have a better understanding, and therefore my conviction level, my confidence level in being able to forecast is a lot higher. And therefore my confidence for this is high. And the rest is, my confidence is less, but I'm trying to show you what the trend might be, right? So that's the purpose of scaling it like that, right? In terms of time periods. In terms of what you're actually showing, key metrics, what we've covered, then key elements of your income statement. An income statement might have 20 lines, or even more if you're a big established business. But in your slide deck, in your summary financials, what people want to see is how is your revenue going to scale? How are the cost of sales, which is the cost of goods sold basically, how is that scaling? Because that tells me what your gross margin is actually. So initially, obviously, I might not be making any gross margin or very low gross margin, but as my business scales, I want to reach very high gross margin levels, which are closer or which are, where I can benchmark with what is there in the industry. So if this is a SaaS business, so you see, right, in quarter 4, it shows 79% gross margin. So if this is a SaaS business, where let's say my benchmark might be in that range or maybe even higher, this is realistic, right? But if you are in a business that is where your gross margins are, I don't know, 40%, then this is totally out of whack, right? So, so some key elements, again, you see how they are kind of the key figures are actually, so they're bold, they're nice and bold. You have units, and you see single numbers, right? There are no decimals, there are no commas, there are none of these things. So from a design, from a point of view as well, it's very easy to read and it looks nice as well, right? Another important element is the headcount, because you want to show how your team scales as well as you build a business, right? And this allows an investor to quickly do those calculations I mentioned earlier. What is the EBITDA per, how is the EBITDA per employee actually changing? How is the revenue per employee actually changing as I scale the business, and so on. Another important element is the cash position, right? Which actually comes from your balance sheet projection. It's the result basically, and that shows me how much money does this business actually need over a period of time. So, and these are, because these are figures for that particular period, so month, and let's assume that, so these are actually in thousands. If you see at the bottom, it's in thousands. So instead of adding those digits here, it looks simpler and elegant and more easy to read because I've removed the thousands. So I know that in month 1, I'm going to be negative 19,000 and so on. At the end of quarter 2, it's going to be nearly 300K negative, then 500,000 negative, then 600. So at the end of year 1, I've already gone through maybe $1.5 million, right? So if I'm going to raise, and let's say what I'm trying to raise is just $1 million, then it means that I'm going to run out in quarter 2, at the end of maybe quarter 3. Which is quite unrealistic. I need to plan for a longer timeline, right? To a runway, as it's called, right? So, so there's a lot that you are saying through this, but you are not crowding it with a lot of the other information that is not required at this stage, right? So the purpose of this is to show the picture at a high level, and then give the opportunity to the investor to ask you questions. So they might ask you, oh, I'm seeing that your how do you think, your quarter 2 to quarter 3 and your quarter 4, actually it's from quarter 1 to quarter 2, you're increasing like 10 times. So what are you actually doing? Is it some marketing activity or is there a product launch? And then you can have those discussions later, right? So that's the purpose of this whole slide, to give you the opportunity to have a more detailed discussion in the future with your investor. And that's when you share your detailed financial model, right? And show how you built these numbers, because all these are summary numbers. They come from somewhere. They are not plucked out of air. Right. So, in fact, there's a very good article. I've put the source here. Good article that I think all of you should read, which details out some of the things that I've mentioned here. So definitely check it out later. I'll show some examples of one-page financial slides, that some of the nice ones that I saw. Right. So this is a slide from LinkedIn's pitch deck. If you see, there are just 2 big lines, revenue and expenses, and they are in bold. right? And these are actually, and then total active users, because it's a, it's professional social media type business. So the number of active users is a key metric for them, which indicates the scaling of the business. Revenue and expenses tells me the story on how value is getting created. And then the headcount and the operating margin. There's literally nothing else at this point. So when an investor wants to know, oh, how have you project? Oh, you're projecting a $50 million business in 5 years. What assumptions have you made? Do you have different revenue? What is the mix of that revenue? So it allows you to spark those conversations, right? And that's the intent of this. It's nice, it's clean, focused on the detail, focused on the main figure. So less is more, basically, right? Another one is, graphs are used, and they need to be used well to give the key message. What I liked here in this slide was how the key message is actually in the headline here, right? Basically showing how my monthly recurring revenues have been increasing month over month over the last 2 years, right? Which nicely basically shows. So how has this growth actually consistently occurred? The answer is actually in the detail, right? Which is consistent with my headline. So again, a lot that you're saying without cluttering the slide or providing too much information or getting too busy, right? Another good example with a little bit more detail than the LinkedIn one is this one, where again, key figures have been put in bold, which gives a little bit more information than the other one. Another way to present it is using, and there are different ways, right? Charts are used here. So revenues, they're highlighting what the break-even year is, and then key metrics are actually shown. So how do you actually meet these revenue numbers, right? It's basically through different kinds of customers, right? To show that these projections are actually realistic, because it's easier for a potential investor to basically question that, is it realistic to get 500 customers in 2015? That was when this was projected. So if you already have, let's say we are in 2015, and in the first quarter of 2015, you already have 100 customers, then reaching the 500 target of PDT customers, then reaching the regular PDT customers, reaching target of 500 is quite reasonable at the end of the 2015, because you're growing month on month, right? So the investor can ask some probing questions and check whether your estimates are realistic or not, right? So how do you actually reach those revenue numbers that you have at the top? So that actually brings me to the end of this section. What I'm going to do is before I take questions, quickly show you. So I've included templates, right, of the example that I explained, which shows in one page, for a SaaS or a subscription type of business, what the evolution is going to be. So monthly for the first quarter, then quarter wise, and then for so year 1, year 2, and year 3, right? And then this is further detail. So year 1, 12 months of the year, and then the year 1, year 2, year 3 summarized. So thought this might be useful. I've put the references there where I've taken this from. Also, another thing I wanted to include was, one resource that I've used in the past, which I found one of the better ones out there, a website called slidebean.com, and they actually have. So their business basically is to make slide decks and financial models for startups, and obviously most of the content is actually paid, but there are very nice videos and a lot of resource material that you can find, on the website. The one thing I like is they actually have detailed financial model templates for startups for different kinds of businesses, right? So they have e-commerce, SaaS, product type business, platform type business, social media business, and so on. They actually have one financial model template that is free to use, right? So you can, So most of these are actually not that expensive, they're like $50 or whatever, but you can just download the one that is free. And that is actually quite detailed. I mean, it will actually help you build something like this. I have used it in the past. I had to like make a lot of changes, but it's a good resource to have, right? When you're looking at your financial models, tying all the three financial statements together into your valuation and your fundraise as well, right? So what I'm going to do is now, in the next 5 minutes, very quickly cover metrics that matter. So here what I'm going to do is, I'm not actually going to go into a lot of detail. I'm going to show you one. So there is actually one very nice presentation which I recommend everyone to watch from Y Combinator. One of the partners at Y Combinator actually given. This is on YouTube. I have the link down here. In which this partner, her name is Anu, she talks about, for the 9 kinds of business models, 9 verticals, based on the different business models that they see, that are typically seen in startups. What are the metrics that investors typically look at for early stage companies, right? And why? And what mistakes people make, right? So here I've just included one example to show you what's there. So for the enterprise business model, so enterprise business is basically could be software or could be a service that you're selling to a large company, to an enterprise, B2B typically, right? So what are the kinds of metrics that an investor would look at? Bookings at the highest level, right? Bookings, total customers, and revenue. So obviously there's a difference between bookings and revenue and so on, right? And how many unique customers are you actually building? So in a way, this is kind of your North Star metric that we talked about last week, right? And then she also points out some common mistakes that founders make, right? I mean, don't mix up bookings and revenue, right? You might have signed a contract with someone, with a customer, but your ability to book that as revenue is an accounting term, right? And there is a meaning to that accounting term, and there is a very strict definition when you can actually recognize that booking as a revenue, depending on the industry you're in and so on, right? So don't mix up the two and so on. So there are, don't include, so letter of intent and verbal agreement is not a booking, but a legal agreement, which is a contract, which is legally binding, where you are defining the terms of the product or the service that you're delivering and the pricing, all that is included, and that becomes legally binding. That is a booking, not a letter of intent, or not a call that you had with a customer and they have been very enthusiastic about, and they've said, yes, we are going to sign up with you. That is not a booking, right? So for each of these 9 different verticals, she actually talks about the key metrics that are critical for early stage companies, and especially what you would be asked for when you pitch your business to an investor. So I will anyway include this video later. The link is here. Take a look later. So with that, I kind of conclude. I think spoken too much. Conclude today's at least this talk, but happy to have Sudhir or other panel members to add to what I've just shared, and also happy to answer questions.